Good morning, everyone, and welcome to the Daily Trader with Kevin Hinks. I'm Kevin Hinks. I have two paper money trades for you today. One, an earnings play in Amazon, and then a good look at a stock that's come down off its highs pretty significantly, and that is Tesla. We'll take a look at paper money trades in both those names. Let's get right to it. First, Amazon coming out with earnings today after the bell. The big news, can they, if earnings come in as expected around $187 billion, surpass Walmart's quarterly revenue? That's supposed to come in about 180. That would be a first in 12 years for the e-commerce giant. So let's see. Now the expected move in Amazon is about $15, right? So, Amazon can be very volatile out of earnings, as you know. So we want to keep this with an opportunity to potentially make money in either direction. If you don't know which direction, this is a strategy you can use. So it's the double calendar. So what we looked at here, buying the February 14th, selling the February 7th. And we looked at the $250 call calendar, trading about 95 cents. It's trading about 90 cents now. So it's a nickel lower than that. So the call, the February 14th, February 7th, 250 call calendar, trading about 90 cents. Then we also went in and bought the 225 put calendar. We put that in at 85 cents. It's trading about 82 cents now. So it looks like implied volatility coming in ever so slightly in Amazon, getting ready for a potential move. Now, if you notice, the expected move is $15. We're about $25 wide on our strikes. The 250 call to the 225 put, you can adjust those if you want, but that's where we lined up our strikes. The one great thing about a calendar spread is you can, customize it to whatever you think. You can move those strikes around wherever you want. You're looking for a move towards one of those strikes, either 250 on the upside, 225 on the downside. And the risk on that trade is whatever the debit you paid. Now remember, if you pay 85 cents on the call side, 80 cents, 82, 85 on the put side, that's the risk on the trade. You can do one or the other, or you can do both. The risk is the debit paid on that trade. All right, now let's get to our second trade of the day, and that is Tesla. Now Tesla, if you look at the chart, it's sold off here in the last few months, down from $488 right after the election, mid-December after the election, to trading about $368 right now. So the trade, paper money trade we looked at here in Tesla was something in a call diagonal. That is, we went out to the February 28th expiration, bought the 370 call, and then went to this week, very tight, February 7th expiration, and sold the 380 call, so a $10 wide. Now, if you look, the expected move for the next day and a half is $12. Therefore, that's a little bit inside that expected move, but volatility in Tesla in the front expiration is elevated. The 71 vol versus the February 28th 57 vol means you're playing the dispersion in the implied volatilities. You can look at that. Now that doesn't mean you're going to be successful, but it means that you're buying the lower volatility, selling the higher volatility. All right. The debit paid for that, we put it in around $16. It's trading about $16.45 now, so it's moved off its lows here this morning, trading a little bit higher. So we did a double calendar on the earnings report in Amazon with the opportunity to be profitable in either direction. And we did a bullish call diagonal in Tesla, targeting the 370 strike and selling the 380 strike. All right, that's our show for today, everyone. We'll see you tomorrow with another edition of the Daily Trader. I'm Kevin Hinks.